morning, everyone, and welcome to the 110th edition of the Veritas Fact-Finding Series. And this morning, I'm joined by my good friend, Steve Saretsky. Good morning, Steve.
Thanks for having me on. Always a pleasure.
Surfacing facts and revealing truths is a never-ending quest for us at Veritas. In each episode of the Fact-Finding Series, we go on the ground and speak to industry professionals in an unscripted, candid video format to discover how we can make better investment decisions. In this series and everything we do, we believe the facts empower investors and that better information leads to better investment decisions. By way of background, my name is Anthony Scilipoti, and I'm President and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada, and I'm proud to say celebrating 20 years, 100% employee-owned and operated. If you like what you hear, give us a like underneath, and please subscribe down at www.veritascorp.com. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas Group of companies may own securities discussed in this broadcast. While we love all our guests, and Steve in particular, this session may contain forward-looking statements, investment opinions, and comments that we may or may not agree with at all. Although with Steve, it's going to be pretty hard not to agree. Listen, Steve, you've been a regular at our real estate conferences, and unfortunately this year, you're tied up. You're going to Italy for a friend's wedding, which is really exciting. But you've agreed to kind of give us a tip your hat early and tell us what's going on the ground in Vancouver. And for those that don't know Steve, we'll just pretend that he's a real estate agent and he has a brokerage, but he's actually an author. He's got a fantastically popular real estate blog, which all of you should subscribe to. And he's not only featured often on the media, but importantly, he's actually testified to the government about what to do with housing. So, Steve, with that, you joined us last fall. And at that time, people were kind of, prices had fallen, but we were and again, like we've been for the last 12 years running this real estate conference, uncertain of where we were going. And now coming into this fall, sort of what's happening?
Yeah, I mean, it's a great frame up. I mean, first and foremost, gonna really miss the live event, the annual housing event there. So hopefully we'll reconnect next year. But I think last year, obviously, I think what we saw was obviously the rate hikes, 100 basis points at a time. I think it just froze the market, right? And so going into last September. It's funny. I remember, I think September of last year. Myself, we'll typically do on average about 60, 70 real estate ends a year. September of last year, I did zero ends for the month, which I don't think I had done since year one of my real estate career. So that was kind of the state of the market. And we were looking at 20-year lows in home sales for many, many months. And the market was really, really frozen. And I think what happened was basically started to see some stabilization in mortgage rates. We came into the calendar year. Obviously, the big concern was, listen, rates are up. They've gone from 1.5% to 5%, and we're going to get this wave of distressed sellers, and inventory is going to pile up, and that's going to put more downwards pressure on prices. And this is the big kind of crash that everybody's waiting for. Prices are already down 10 to 15%, and it's only going to get worse from here. And I think what we saw was this stabilization in rates. Obviously, the Bank of Canada took their foot off the gas just before the spring market. And we saw prices actually rip higher, which was definitely a bit surprising. But the biggest story behind that was the lack of inventory. So it was actually the complete opposite. We saw, I think for the first four of the 6 months this year, we actually had 20-year lows in new listings.
Yep.
20-year lows in new listings. As of the end of August, or it was July, as of the end of July, we had the lowest standing inventory in Greater Vancouver in 20 years. So it's just really, really hard to have prices correct when you literally have nothing for sale. And so this has been the biggest driver for supporting home values. And so we've actually seen an increase in home prices this year. But I would not say it's definitely not a healthy or strong market.
The prices suggest that things are strong. But as I've intimated on our own sessions when I do our one thing videos, where I explained what I think is happening is people are in denial, right? The buyers don't want to buy and the sellers don't want to sell because no one believes the price. And as I prepare up for this conference this year, many of the presenters are sharing those same sort of sentiments, whether it's on the institutional or the commercial side as well as the residential side. So how do you see this playing out? Because clearly we don't have price discovery, right?
Yeah, I mean, it's funny, right? Because like the Bank of Canada comes out and they pause, they move to the sidelines, and they started coming back with more rate hikes. And one of his commentary, Tiff Mackham's commentary as well, housing's been more resilient. And I would argue like it's been resilient, but it's not a strong or a healthy housing market. 20-year lows in sales, 20-year lows in listings, just very, very little turnover. And it's to your point, right? I mean, the lack of affordability, it's not driving any housing activity. And so I've actually made a thesis for the past sort of 6 to 12 months. What I've argued is that the Bank of Canada has actually locked people into their homes. And we can kind of get into the dynamics of that. But you think about all these people that are in their houses. If you want to move, you got to stress test. And so, you got to stress test today at 8%. So if you want to move, usually you're going to look at upsizing a lot of the times, right? So it's like, well, I would argue that a lot of people that are in their current homes a lot of them probably won't even qualify for their existing houses, let alone trying to upsize. So like you might want to move, but you can't. And so like that's obviously suppressed the number of listings coming to market. And then you're seeing that in the sales as well. And the other thing too is if you think about it, is like even if let's say you make a lateral move and you want to port your mortgage, well, you typically have it's between 90 to 120 days to port that mortgage. But if you're looking at the market and saying, there's a 20-year low in inventory, are you really confident that you're going to make that move? Because you got to port, your 2% mortgage rate within 90 to 120 days, depending on your lender. And so I think that's basically everyone's going, well, I got nothing to buy. I certainly don't want to sell, because if I sell, I've got 6 to 8 weeks to try to find a place and then another 4 weeks to try to close on it. And so people are just kind of like held back and saying, let's just wait and see how this is all going to shape out. So long story short, I think that people are kind of in denial. Let's hope this kind of passes. We can get into that because I've got lots of anecdotal conversations that I'm having with investors, some past clients, random people that reach out and ask for help. And I do worry about what might be coming.
So let's dig into that. Let's talk about what's going on the ground, because that's why, we've done numerous mystery shops with you. And, last year was in particular, we came out there and we saw some properties where the prices had been coming down, right? All of a sudden, it's like they'd made big gains from 2020, 21, and early 22. And then when we came and did our mystery shop in around the spring of 22, prices were already starting to correct, right? And it's amazing what's happened since. So let's talk to what's going on the ground.
I think there was a little bit of a flurry of activity. So like obviously spring market, pretty decent. There's a little bit of flurry of activity in sort of this summer, which was quite unusual normally, right? Like summer's usually pretty slow. If you look at the data, it really wasn't that great, but there was a decent amount of activity. And what we saw was a lot of buyers actually rushing to try to make purchases, because they had these rate holds. They said, I've got a 3-year fix that's held until September 15th, and it's at 4.99. That's not a terrible rate, considering that rates are now at 6.3. And I want to make a move. I've been looking for a while. So they were trying to make like a rush decision almost. And if you think about it, right, you're trying to make that decision in an environment where there's basically a 20-year low in inventory. And so you weren't getting any price discounts. A lot of the times you were competing in multiple offers, but people were like they wanted to move. And so there was a little bit of a flurry of activity in the back half of summer. And what we've seen, again, is so early. It's only been a couple of weeks here into September, but we're seeing the usual uptick in seasonal listings. So listings are picking up quite a bit. And I've noticed the sentiment over the last couple of weeks, people are not in a rush. A lot of these rate holds have now expired. And so people that are looking to purchase today are looking at minimum, 5.5, 5.6, 6.2, 6.3, depending on when they held their rate. And so you just look at that and say, well, the prices really haven't changed. In fact, they're up year to date. I think they're up 8.5% year to date in Greater Vancouver. And so there's no affordable. What's the rush? There's no rush. You no longer have that more attractive rate hold in place, motivating your purchase. And so that's what we're seeing. I start to worry that September and October is typically when you get your bump in seasonal listings. And I don't think the demand is there to meet it. And I think it's only 2 weeks in, but I think that we're starting to see that. We're starting to see even good listings coming to market, not getting any offers. And you're like, well, that's unusual.
But we know that sentiment plays, that it's sort of that intangible, right? Because we can say, oh, look, there's a lack of supply. And that's what, our regulators, the CMHC will tell us, all our governments will tell us we have a lack of supply. But as you've pointed out, part of that reason for that lack of supply is the inertia behind people just not possibly or not able to transact. So what's the sentiment like? So these people that want to sell, you're saying they don't want to sell, but are they nervous? Are they starting to say, you know what, I can't take this pressure? And that's why we called this year's housing conference the squeeze, because everybody's under pressure.
Yeah, you know what? I mean, I love having I love having these conversations with just interviewing. I mean, and you and I are obviously, I think, cut from the same cloth, which is I just love hearing other people's anecdotes, which is, every day going to the office, I chat with all the other realtors. We've got a lot of top performers in our office, or chatting with different lenders, whether it's at RBC, BMO. I just like to hear, what's your pipeline? What are you seeing? What are the conversations? Because I see what I see, but I want to keep my biases out of it and try to get different anecdotes and perspectives. And I think one of the things that I think is kind of stacking up is just more and more calls on, hey, this is my mortgage situation. It's what do I do? As I think these conversations, the conversations that I've had predominantly has been, oh, it's a variable rate mortgage story. I was on this fixed payment variable, so the payments haven't really gone up, and it'll go away in a year or so. And I think we're starting to see, well, hey, it's a year later. Rates haven't come down yet. In fact, they've actually gone higher. And so people are going, oh shit, now what? And not only that, but now it's becoming, I think, a fixed mortgage renewal issue, which is, people coming up, had a couple conversations last week, right? It's hey, my mortgage is coming up for renewal. I thought I was smart. I locked in 5 years ago. 5 years ago, all of a sudden you're coming up for renewal and you're going, well, 5 years ago was at 3. Now it's 6.2. And I think most people, the variable rate mortgages are obviously figuring out who the Bank of Canada is. But I think if you're just a normal Canadian, I don't think you're paying attention to the bond market and where rates are. If you locked in 5 years ago, you probably haven't been paying attention. It's only when you get your letter in the mail that you go, oh, this is interesting. And I think we're seeing more of that too on the investment side. It's, hey, I don't want to sell my investment property. I love holding these things. The market always goes up. I'm cash flow negative, $500, $600, $700 a month. But, I'm hoping this is going to figure itself out. And again, it's been 12 months now and it hasn't figured itself out. And so a lot of these, we're getting more and more calls from investors as well saying, I got to stop the bleeding. And what do I do? And so, that's a lot of the conversation.
But stop the bleeding, but they're not putting stuff on the market at forced sales, right?
No, and I think, obviously, as of right now, they haven't had to. Anyone that's had an investment property, they said, I got to stop the bleeding. If they had to sell it, over the last six to 8 months, I think you've actually done pretty well on the price. You really haven't taken any discount, and you haven't had to. So you might have been a bit stressed and really kind of wanting and needing to sell, but you haven't had to reflect that to the market, because I would argue that sellers have actually had the upper hand throughout pretty much all of this year.
Because there's no supply.
There's no supply.
So sellers, and I don't know what you think about this, but this is what we've been advising people is like, if you have to sell or have the inclination to sell, don't wait till all the pretty girls come to the party. Do it now when there's nobody there, because there's better opportunity.
Yeah, I mean, that's certainly the conversation that we're having with like our clients that are, genuinely, if they have to and need to sell, that's the conversation we're having. You're better off. Our view is that you're better off to set the market than you are to chase it lower, which is difficult for a lot of people mentally to say, hey, I got to take less than my neighbor did 2 or 3 months ago. But if we look at, I think, where the ball is going, I do worry that you're going to have a mismatch between supply and demand, which is the opposite of what we've seen this year. We've seen more demand than listings coming to market. And I worry now that rates are back, up in the 6s. And even if they come down into the mid 5s, I don't think that provides enough relief. I think we need to get it under 5.
If anybody has a question, we're live here. I'm down in Niagara and Steve's out in Vancouver. If anybody's got a question, please type it in. Just hover down at the bottom and over the Q&A, and I'll make sure that Steve answers it. So you said where the ball is going. So why don't we follow the ball bounce a little bit and get into projecting? And what do you see happening? And what is it that you're watching that makes you have that view?
I think it's just you run the math on the mortgage payments and more of these investments. I don't think I've sold an investment property this year on the buy side. The numbers don't work. It's too hard to pitch. It doesn't make any sense. And that's much different than.
So no longer are investors coming to the party to make the purchases. It's all, individuals, actually homeowners that want to buy now.
Yeah, exactly. And I think we've seen that pretty much throughout this calendar year. It's like, where's the most activity been, the most strength? It's been still in that sort of pandemic era housing type, which is entry-level house, entry-level townhouse, something that a growing family needs. That's where we've seen the most activity. We've seen a ton of activity this year in one-bedroom condos, a lot of first-time home buyers saying, hey, I'm sick of renting. I've been saving up for the last 8 years. I'm going to get into the market. So that's where you've seen most of the pressure on pricing, and it's been an incredibly tight market. But you haven't seen a lot of investors, and I think they're very few and far between. I think you've seen more investors selling than you have buying, which is a stark contrast from during the pandemic, of course, where I think everybody was calling up and saying, hey, I got to add to my portfolio. I'm falling behind, right? I mean, everybody's borrowing at 1.4%. Everyone's prices are going up 15% a year. I can't save this kind of money if I don't get in now, or if I don't buy a property for my kids, today, in 10 years when they're growing up and going to university, I mean, what kind of future are they going to have? And so those conversations today
we call that FOMO. At least my kids call that FOMO. So it's interesting. So when you look here, so FOMO was really because everybody coming into the pandemic, and you and I have discussed this both on the panels and also offline. Coming into the pandemic, everybody, including CMHC and everybody, thought the market was going to fall apart, and it did anything but that. It actually took off to levels we've never seen before, right? And so now I just read recently that investors representing 30% of homeowners or unit holders in the real estate market, if that 30% goes away, that's a big part of demand, right?
Yeah, it's a huge part of demand.
So again, let's keep going down the path. You think that that basically you're seeing that prices don't hold here?
I am incredibly skeptical that you're going to see prices hold. I think we're seeing a softening now. So I mean, I wouldn't be surprised if we gave up our year-to-date gains. I mean, I'm not saying that's going to happen in the back half. Like I said, I think right now we're up 8.5% year-to-date. And I think we're going to give a chunk of that back in the later half of this calendar year. And I think 2024 is anyone's guess. I mean, I think there's a ton of risk out there. I think it all depends on the trajectory of interest rates, mortgage rates, for that matter. I think the underlying demand is there. I mean, obviously we can talk about, the immigration side. So I think there is an underlying demand there, but when prices start falling, it tends to feed on itself. And if you don't get mortgage rates down from an affordability perspective, it's hard to really see demand pop back, because it's just, you look at the math and it doesn't make any sense. To borrow at 6 when you have no price discount.
And also the cap rates, just, if you were buying at cap rates at low single digits and now they're mid to high single digits, it just doesn't work anymore. It's upside down.
Yeah, you just can't justify the math. It just doesn't make any sense.
We're getting some great questions here, so let's dig in here. Thanks, Monica, for the question. So and I think we answered it, but I'm going to let you take the question. The percent of investors present in the market relative to the past, and can you some numerical data versus end users?
Yeah, so unfortunately, we don't have granular data like Toronto does on the investor side, because we don't really track the MLS here. Doesn't really track the rental market, so we can't parse data. Like I know John Pasalis does a great job of that in Toronto. So we don't have.
Mentioning that.
Yeah, I can tell you
that at the conference. But go ahead.
Yeah, exactly. I can tell you from like the pre-sale data. If you look at some of the data that's come from these pre-sale companies here in Greater Vancouver, I think in more recent years, investor purchases of pre-sale units has hovered kind of around 70%. So they drive the vast majority of the pre-sale activity. I don't have I don't want to like throw out a number for the resale market.
How about just gut feel? Well, that's the beauty of this kind of discussion. You've been doing this a long time in Vancouver, and you're a numbers guy. What's your sense of what
I would say inner city of Vancouver. So we're talking downtown and surrounding areas, Olympic Village, in the inner city core. I would say it's close to 50% for like a 1-bedroom condo.
And that's pretty consistent with what I've heard here in the GTA area with among the large developers. Let's get to another question. Thanks, Raymond. How many investors, or how are these investors dealing with the negative cash flow every month, since they're not rushing to sell?
That's a really good question, and which is why I think this is like the great. I mean, to your conference there, the great squeeze. So BC has like even more strict tenancy laws than Ontario. Yes. So, and this is a lot of the conversations that we're having is, so in BC, if a tenant is in there, let's say they usually would sign a 1-year contract, automatically they always roll month to month. That's the automatic. They automatically get month to month. The only way that you can get them out is if you go and live in it for minimum 6 months as a primary end unit. So you can kick them out to live in it for 6 months, or you have to do a substantial renovation, pull permits, etc. So what happens is when you go to sell, when you've got an investor in there and you're only allowed to raise the rent. So during COVID, it was 2021, it was 0% rent freeze. Last year, it was the year 2022, I think it was 1.5% or 2%. And then this year coming up, they put it for 3.5%. So well below the rate of inflation. Which is actually against their mandate, because they said you can raise rents with inflation, and they've actually changed that. And it used to be inflation +2. So these landlords have these tenants in place. They can't raise the rents more than, let's say, 2%, but your variable rate mortgage is up, 400 basis points, 500, pick your number. And you're stuck. And so what we're seeing some people do is, obviously some were just saying, there's nothing I can do. I got to sell. I can't bleed $1,000 a month. And so they're either having to sell. We're seeing some people renegotiate. So they're coming to the tenant and they're saying, listen, I know the tenancy laws, and either I'm going to do 2 things. I'm going to move into it personally, in which case you're going to have to leave because this is my mortgage situation and I can't lose $1,000 a month, or I'm going to have to sell. And chances are the new owner is probably going to want you out. So I know we have an agreement where it says I can only raise the rent 2%, but I need you to sign a new contract, which allows me to raise the rent, $500 a month or whatever it is. And so a lot of the times the tenant's going, well, okay, I don't really have an option because the new rental, the market rate is substantially higher than what I'm paying. So I will voluntarily sign a new contract. So we're seeing quite a bit of that trying to get around the rules basically. But even then, it's like, even if you get a tenant back up to market rent, a lot of the times you're still in a negative cash flow situation, because again, a 500 basis point move in your mortgage rate, it's hard to cover.
And what we know is by the end of this year, Bank of Canada published that mortgages, if you just take them, the ones that started from the beginning of 22 till the end of 2023, 48% of mortgages will have reset, and reset at anywhere between 10 and 50 or 45% higher payment monthly. So we go back to our squeezing here. In place.
Yeah, can I just comment on that, on the tenancy side of things as
Please.
well? So think about this. Let's say you're an investor, you're losing $1,000 a month, you're negative cash flow. So you say, I'm going to sell. So you put your unit on the market. There's a tenant in there. You know, the only way you can kick them out, right, is if the new buyer says, hey, I'm going to move in. I want this guy out. You know, the new buyer can't say, hey, he's below market. I want to put a new tenant in at a higher rate. No, you can't do that. It's only if you want to move in. So when you go to sell your investment unit, you've almost eliminated the investor buyer, because the investor buyer says, well, why would I want to assume your tenant that's $1,000 or $500 below the market, and I legally can't get them out unless they sign a mutual agreement to end the tenancy? Which is, why would they do that? Because they're gonna you've eliminated the investor demand for a lot of these units. So you think about it, right? The rents have gone up quite a bit over the last 24 months. So most people that are in existing tenancies are well below market. Now you try to sell a well below market rental property, no investor is buying that. So you're exclusively almost relying on an end user to come in and buy. So you've really eliminated a lot of your buyer pool.
Which is very interesting, and always the point we keep making about that real estate is an illiquid asset. You know, it's pretty easy to get in generally, but to get out, besides listing and transaction fees and timing between when you close and when you actually sign the deal, and then having to deal with the tenant, it's a real issue. And I will say many investors, I think many investors are unaware of just how much roadblocks, how many roadblocks exist in those scenarios.
Yeah, I think BC is probably one of the worst provinces to be a landlord. I mean, I think it is what it is. But
well, Ontario has big problems with it as well. The only places that work are places in Alberta and Eastern Canada, because there they don't have rent controls.
Yeah.
All right, let's get to another one. It's an anonymous one, so it's going to be tougher, right? Steve, do you think the government can do anything in the short term, either current or maybe a new one, to help with the lack of supply?
No, I mean, I think like there's kind of a double, two sides to it. I think in the near term, I think you've got enough units like under construction that will come to market. And so I'm less concerned about the next, 2.5 years as obviously rates are elevated. I do think like if you project further out, I mean, what we're seeing now is obviously a decimation of new housing permits, right? Permits. I mean, so you look at housing starts, maybe they're still relatively elevated, but permits are getting annihilated right now.
Yeah, because even now for the developers looking at the situation going, well, if you had 50-70% investors that were willing to purchase previously, and that pool of buyers said, see you later, the math doesn't work. Now all of a sudden, there's no point in building it. Plus my costs are up, etc.
Yeah. I think the biggest thing is the costs. I think there's, the pre-sale demand here it's softened. It's not horrible, surprisingly. I think, I do think this is funny enough. I mean, it's not my view, but this is what we're kind of hearing and seeing is a lot of these investors are going, well, the mortgage rates are really high. The numbers don't work today, but this pre-sale is not done for 4 years. And you know, a lot's gonna go right in the next 4 years, so they'll plunk down. And again, I'm not saying that pre-sale demand is strong, but it's not as bad as one would think it would be. But I think the biggest thing we're seeing with developers is just obviously the cost of financing these projects. The cost of building them is still incredibly elevated, and you can't pencil. The risk reward isn't there, and so we're seeing a huge drop off. You know, developers just sitting on sites.
We're going to have a new panel this year. We're having some alternative lenders, so working on ROMSPEN. Hopefully they
Yeah, that'd
come.
be cool.
But if they don't, we got Cameron Stevens, we have Atrium Capital, and we're going to have someone from Marathon Mortgages, who you know, a monoline lender, to really think of, because I think, what are your thoughts? But where do the cracks form first on the lending side?
Oh, I think there's I mean, I don't know. It's kind of, I mean, it's hard to say. I don't.
Okay.
I mean, obviously the private mortgage side, right? Everybody kind of knows that space. I mean, the crazy thing is at 6%, you're paying private mortgage rates, you know, from 18 months to 2 years ago. That's your tradition. So, you know, I was dealing with an investor the other day, actually, and they had, what do they have? They had about $20 million of real estate. $20 million of real estate, then they couldn't rub together 100 grand. And basically, you know, they came to me and said, "Hey, I got this site. I want you to help me sell this site." And I said, "Well, you know, in order to sell this site, we need about $100,000 investment to get it up to snuff." And well, we don't have that money. I said, "Well, you own $20 million of real estate." But anyways, the long story short was the lenders were wanting their money back. I think they had cross collateralized multiple sites, and you know, it works well in a bull market, of course, but I think basically what happened was, you know, this investor didn't have the cash flow to actually service the rising cost of interest. And so I think there's a lot more of this out there. I mean, we've seen some of the stories in Vancouver, you know, these fly-by-night developers, Coromandel being the big one. I think I had flagged them many years ago. But you know, they own like 7 or 8 sites, some big sites in the city of Vancouver, and of course, it all came crashing down because the conversations I was having with some of their own lenders was that these guys are just continuously refinancing. Right, every year the land value in Vancouver goes up 10%, like clockwork, and just.
But homeowners were doing the same thing. Small investors were doing the same thing at all level, right? Take that and use the house like an ATM. All of a sudden, that changed.
Yeah.
Just in the interest of time, and I want to respect your time and our listeners, we're going to try to wrap this up. The last 2 things, let's talk about what's happening with foreign buyers, and let's also talk about, and I'm going to lead that in with a story. And as people say, we're going to pull it away. I'm getting lots of questions. Take you back to about 2015 and 2014, 2015. I did a mystery shop out there at the Concord area, you know, near the Rogers Center.
Yeah.
And I went. I'll never forget this. I still have the paperwork. And I went in, and I was the odd, the foreigner, if I can say that. And when I went in, I finally got the attention of someone that was trying to sell, and they came up to me, didn't speak English well, and I said, "Look, I want to buy a property," and they said, "Okay," and I said, "But there's no prices anywhere, so how much are they?" And they said, "Oh, it's at the time it was like $1,700 a foot." I said, "Wow, that's pretty good. What can I rent it for?" And they said, "Rent? I don't know. You know, you could rent it probably for this or that." They gave me some round idea. And so, what's my cost to carry? And then the woman said to me, "Where are you from?" And I said, "Well, I'm from Toronto." She says, "Obviously." She says, "Listen, no, all these people in here, they're not buying these properties to rent them. rent properties only go up here. And I said, really, why do they go up? Well, this is such a great place to live. The sun, the light, the health, the availability of infrastructure, everything's fantastic in Vancouver compared to where all these people around us were coming from. And that's what it was like. They said, this is probably not your market. And I said, yeah, I guess I can understand that. So now that doesn't work, right? Because people can't buy with the, do you think this mentality of the foreigner is going to stick around? Because that, and it ties to our argument of immigration. How does that play out?
Yeah, I think the foreign buyer stuff is definitely a small fraction of what it was in 2015, 16. I haven't really seen any uptick in the last 12 months or so. Obviously with like China reopening and stuff, haven't really seen much of that. But I think the reality is a lot of that money is already here. So you still see a lot of these like high-end homes that are selling, or obviously, local Chinese Canadians that, have businesses and maybe are only here periodically. But in terms of like the huge inflows from 2015, 16, I mean, that's just never returned. And you can see that right in the high-end market. I mean, those prices have been depressed for, what is it, 8 years now? They're down about, they dropped like 20%. They've kind of just petered it around, and they haven't really moved in the last 8 years. So it's been a losing proposition for that market. It's gone nowhere for 8 years. So that's one of them. I think that the high end, I think you were here last year, we did a tour. So that high end luxury pre-sale market still a really tough sell. We had one that pre-sold, and
tell us about the decorator discount.
Oh yeah, we got the decorator's allowance. So they do, instead of reducing the price, they call it a decorator's allowance, which is basically they say, well, $100,000 decorating allowance, we'll just credit you, we'll give you the credit on the closing table when you go to your lawyer. So they kind of give the illusion that they've sold it for this price, but in fact there's $100K discount that's given at the closing table. It's I guess it's a BC thing, but it's pretty popular here.
So let's just wrap up with a couple of good questions from the crowd here. Monica's asking back here, do you think that there really is a lack of supply? And we talked about this, right? Because we have been building, people die, yes, immigrants come, but is the demand just coming because of extraordinarily low rates? And John did some work on this, and he'll expand on it, where with the number of people that own more than one property is at a record level.
Yeah, I mean, I think I think I have several opinions on this, which I think there is a true underlying shortage, and I think there is a housing supply crisis for sure. I think it's maybe a little bit played up by the media and the industry as a convenient sort of misnomer to, don't look at the banks, don't look at the mortgage lending boom that's happened over the last couple decades, don't look at the zero interest rate policy over the last decade, don't look at the foreign money that's just flooded into this market. So there's a lot of things that are moving the demand side, but the one thing I'd say is like prices can really detach from reality and supply demand through the FOMO and all that other stuff. But I think if you look at the underlying, I always think the rental market is more a function of supply and demand. And so the fact that we're still seeing aggressive growth in the rental market, to me, I think suggests that underlying we don't have enough homes. And I don't think that, hey, you build all these homes. Like, I think the big misnomer, and I know you have CMHC coming to your thing this year, is if you look at the report, they say we need to build, I don't know what it is, 6 million homes by 2030. And that's under the assumption, if you look at their modeling, it says, so if you get the 6 million homes, it will lower prices by like, I don't know what it was like 15 or 20%. But that's just not realistic. It's not reality. A, you can't build that much, but B, no private developer that's sourcing capital, particularly from the banks, is gonna be able to get financing in a market where prices are dropping, 5-6% a year. Nobody builds. It's like what we're seeing right now, right? Market's kind of crappy, prices are softening up. Developers are pulling back. So I don't think you're necessarily going to be able to build your way out of this. I certainly think we have our challenges with municipalities. We need to build more rental housing. So there is a supply issue there, but it's not so simple as just opening the floodgates.
Very interesting. Let's get to this, our last question, and then I'm going to launch our poll. It's a good one. Thanks, Raymond. Among investors you've worked with, and we're going back here now just till since 2020, roughly a percentage of buyers, all cash, big 5 bank financing, B lender, private lender.
I mean, I'm probably not the best barometer of the typical investor. I tend to think like we try to do a good job of educating our clients. I think they tend to share similar worldviews as myself.
You actually advise them not to buy. That's why I tell people, anybody in Vancouver wants to deal with somebody, they should deal with Steve, because he'll actually walk in and say, just, I know I make money when you trade, but don't trade today.
Yeah. It's just I think it's just understanding where the market is and having realistic expectations. And so, for our clients, it tends to be, we don't tend to have investors that are all cash. We tend to have, a lot of we'll tend to have local working people here that just want to add to their portfolio. It's usually a 1-bedroom condo for $650,000. They're not usually levering at 80% loan to value, because if you do, you're cash flow negative, which we highly recommend against. So yeah, and I will say this, so is the financing is almost always from a tier 1 lender. I wouldn't sleep at night if I let my investors, buy an investment property with private financing or B lending.
But now, as these investors are coming to you, that you talk about that guy with a $20 million worth of a investment portfolio, and all of a sudden he can't make $100,000 come to light. Clearly, he's going to have to find it from somebody. And it's interesting, we obviously cover stocks in the other part of our business, and we cover Go Easy, and Go Easy is they're a payday lender. They're basically having record results. B lenders, record results, because once you're basically, as you've said, locked into your home. So when that new renewal shows up, and you might not like the rate, it's like you can't go anywhere. You're just locked in, because if you try to requalify somewhere else, you can't get you are not going to be able to afford that house.
Yeah, and I think there's, the next risk moving forward is, in the pre-sale space. Obviously, I think right now we're not I can tell you truthfully, having conversations with mortgage brokers that are working on all these files, we're not really seeing a lot of stress in the pre-sale side, which is people that can't close. I think, and the reason for that is because there's actually enough equity there. In most cases, hey, we bought it pre-sale, whatever, 3.5 years ago. Market's gone up X%. There's still enough equity, so they're sort of being able to sort of finagle and figure that out. But I do wonder, as you get pushed further out, hey, you bought that pre-sale in 2022, okay, and now you got to get stress tested at 7.5%, 8%. I think you're going to run into more and more issues, and so obviously maybe they end up going down into the B lender route or the private financing route, and then it's just a matter of mitigating losses at that point.
Last thing, let's look forward. Here we are. It's September 13th, 2023. If we had to look, and it was today, September 13th, 2024, what does the Vancouver market look like?
Ooh, it's a tough one.
Heavy.
Yeah, I will put my asterisk next to this, which is I think there's a lot of things that could potentially happen with rates. My personal opinion is I think the economy is going to roll over hard. Just because I just think the conversations that I'm having with people saying, individual person saying, hey, I took out a condo, and I can tell you, this is a real case story. When I bought my condo 2+ years ago, my monthly payment was $1,500 a month. I'm on a variable rate mortgage. Now it's $2,300 a month. And it's well, $800 a month after tax income from a single individual. That's a lot and so they're just, the conversation was, I'm going to start cutting back on restaurants. I'm not going to go on that vacation this year. And so I think you just start multiplying that by not just the variable rate mortgage people, but the people that are renewing their fixed rates. The longer that rates stay higher, I think it's going to really eat into the economy. I think we're going to roll over harder. I'll say I think prices from today will be 8 to 10% lower next year.
Okay. With that, I'll let you go. Steve, I'm going to be out there in a few weeks, probably after you come back sometime late October. We're going to do a mystery shop. Like, I want to go see what's going on at some of those pre-sale places, and maybe we can go up to the Guinness lands and see what's happening up there.
I think, yeah, that one that we looked at with the piano player and all that funky
Yes.
stuff. There's rumor that I can't confirm them, so don't get too hot to trot. But there's rumors they're running into some capital issues there.
That's West Bank.
Yeah. So there's
I said it. You didn't say it. Okay. Thanks, Steve.
Anyways, there you go.
Thanks, everybody.
Yeah, Anthony.
Bye-bye.
Always a pleasure. Take care.
Likewise. Keep it up, Steve.
Cheers.